I'd like to thank you for joining me for the Rainmaker Investor Show. After a long hiatus, we're back. I'd like to thank all the folks who are come over from Real Vision and my subscribers. Let's get started right away and start to talk about 2017 and what narratives have already played out and what we think is going to happen here in the future. So first thing we started with this year was this idea of a new Cold War, right? And there's this idea that although there are these enemies, ISIS and terrorism, those are not the type of enemies that you activate battle groups to, right? Nuclear warheads. So we talked about an idea of a new Cold War, a new cyber war. And a few months into the year here, it looks like we're right on track with that. Power going out on the East and the West Coast, cyber hacking all over the place. When it comes to this idea of a new threat, right? It's a digital threat that affects everybody. And I don't think it's over. Right? I think you're just seeing a couple tests of the emergency broadcast system, but soon I think you're going to see an event that, that shocks the world. So from this idea of a new Cold War, we talked about the report from Iron Mountain, 1963. So we're going to start with this quote. Why is war so wonderful? Because it creates artificial demand. The only kind of artificial demand, moreover, that doesn't raise any political issues. War and only war solves the problem of inventory. So this was, our theme that we talked about from the beginning of the year because we need growth, right? War affects total factor productivity to the upside. This morning, total factor productivity came out, fell 0.6 rather than 0.1, right? So there's a big problem with total factor productivity, and building submarines and warheads fixes that. So we talked about some of the catalysts of the market, right? We said there's going to be a war. Some of the things that a lot of folks have been talking about, the tax cuts, the fiscal spending, infrastructure, haven't materialized, right? So we're sitting on 0.7 GDP right now. And obviously, it's residual seasonality. But there's this idea now that we're going to get a big bounce back. And even I agree, there's going to be a 2.5, 3.5% bounce back. But this question is, can we operate at 3 or 4% like they were talking about? Giving rich people extra money, I don't think is going to do it. Call me crazy, but again, this is about total factor productivity falling, GDP south of 1%, and rates rising anyway, right? Because here's the thing, and we talked about this early in the year. Everybody knows the best market in the world is going to be to put your money in the U.S. market, right? Because it's U.S. dollar denominated, rates are rising, if stocks can continue to run, that's where you want your money, right? So there's this idea that everyone's going to be pouring their money into the U.S. market. So what have we seen so far? It's, May 4th, and we haven't gone anywhere since March 1st, right? 2,400 was a hard deck. We haven't risen above that for 2 months. So this idea that there's all this money pouring into the market, but that we haven't really gone anywhere, means there's a lot of pressure, and I believe it's to the upside. I think we're going to go higher for stocks. But we're going to talk about that later. What I want to talk about now is the wonderful development this year of the rain or shine. Now, everyone knows, years and years we've been talking about this strategy, the rain or shine. So for new folks, this is what it is. It's a passive strategy, right? Passive strategy is all the rage now. We've been talking about it for years, but passive strategy is all the rage, right? Set it and forget it, buy and hold. So our buy and hold 3 security portfolio mix, 40% SPY, 40% TLT, 20% SVXY, and that's a short volatility ETF. So for years that's worked. It's been a pretty good allocation. It's it's like an all-weather portfolio, right? It's stocks and bonds. Governments of the world buy stocks and they buy bonds. So that's what we buy. And it's 20% short volatility. So we're going to go into that now. But this year what we came up with is another idea, even more dynamic, right? The rain or shine active momentum strategy. So I know some folks say, oh, momentum, right? Here's the thing. This strategy works in rain, shine, stocks are going up, stocks are going down. It works, right? But sometimes you get to these, if we think about it like a race car, we're driving this race car around and we're just driving one speed, right? And driving around, it's one speed. Now, if we got to a straightaway, wouldn't it be great to hit the gas and speed up? And if we got to a corner where there was a particularly dangerous thing happening, like a French election on the weekend, maybe we could slow down, instead of being long stocks and short volatility into these major events. And so that's what we did. We decided, we said, well, you know what? Instead of static rain or shine portfolio where we just set it and forget it, let's look to augment the strategy with a fast car and a slow car. Right? So the fast car, we call it the green car, 50% SPY, 50% SVXY. Some folks are, oh, shorting volatility, that's so dangerous. You get it? We're going to go into the details a little bit. I understand what you're saying. And then the red car is 50% short SVXY and 50% TLT, where you own TLT, right? So we're buying long bonds and going long volatility into the event, right? What we really realized, which was probably better than everything, is that it's not about being long volatility and long bonds into this event. It's about being in cash, right? So I'm going to tell a story from back 2001 now. I was working Morgan Stanley, young broker. Guy calls up. I call him, actually. I'm cold calling. And we just started offering the choice accounts, which were all-inclusive, fee-only accounts. Put your money in, you pay 1% for the year, and you get all the transactions inside. So cold call this guy. He says, I'd like to see if we can trade mutual funds. I said, yeah, oh, absolutely. He says, yeah, I got a 401k I'd like to transfer over to you. He goes, but I want to make sure about the rules. So yeah, no problem. Swing down, takes the money, puts $1 million in the account. I'll never forget this day. First day, he calls down. He says, yeah, listen, I want to make a buy. So stock market's shooting the moon. He says, I want to buy all of it in Oppenheimer, Nikkei Japan Opportunities Fund. Swear to God. So I go to put the order in, phone rings, it's the overboss. He says, listen, what do you think you're doing down there? And this guy, and apparently a lot of folks are doing it, had this strategy where he was timing mutual funds. Big day in the United States means a big day in Japan. They buy the mutual fund at 4 o'clock. The next morning they call in and they sell it. So the next morning the guy calls up, market's up 2 or 3%. He's like, yeah, I want to sell everything. So I call down to the boss. Boss is like, you can't sell. You can't sell. What are you doing? So they allowed him to sell. But it was this idea of capturing a small gain and going home that we learned in 2001 that's helping us here today, right? We said, well, shoot. Back then, the transaction cost was huge. Now, TD Ameritrade took the transaction cost from $7 down to $4. Soon it's going to be even cheaper than that. All right, so what are we doing? We're taking advantage of the liquidity in the market to outperform, the indices. So this idea of the 3 cars has really worked good, but I want to talk about the performance now. So I'm going to go now to this year's rain or shine performance, just year to date. We set it up in motif.com's audited number you can find anywhere on the internet. 16.9% year to date, right? 17 weeks into the year, up almost 17%, 1% a year. Okay? You didn't have to do anything. You have to short. It's just the regular portfolio, right? But now I want to go all the way back to February 11th last year, right? We talked about stocks were falling. It was a big problem. And then February 11th, everything flipped. And since then, we've been off to the races, right? So I want to pull up this chart. Here's this chart here. You can see it. From that low, the S&P is up 32%. Okay, 32% from the bottom there, February 11th, till today. The rain or shine green portfolio, which is, like we said, 50% SPY, 50% SVXY, is up 32.6% year to date. Okay, and I think to myself, maybe the rain or shine green portfolio could replace a lot of other things that I'm investing in that are a little too risky. Right, so think about this for a second. I'm going to pull this up because this is going to really shock you. The rain or shine green portfolio is up 187% since February 11th. 187%. I had to check this to make sure this was right. I didn't know. 187%. Okay. SVXY alone is up 342%. Okay, so I also pulled up underneath, the Fabulous Four, Fang, Amazon, Facebook, Google, Netflix. Amazon was up the highest, up 90%, right? So Amazon was only up half of what our very generic green, swing of SPY and SVXY together was up. 500% of what Google was up, right? So start to understand this, that we're trying to simplify the market by doing what? We only buy the securities that the governments of the world buy, right? If they just bought $1 trillion of securities out there, if we had this list of securities down the list, it would be the SPY would be number one, TLT would be a few spaces down. They might mix in some Dow, right? But they're not buying NVIDIA. They're not buying NVIDIA. No. So if this was a car race, the volatility is at the front of the pack and at the back of the pack. In the middle of the pack, relatively, volatility is not as volatile as these other places, right? So we're trying to be safe because we're using a security that's still stocks. I mean, they can still crash, right? But if we took the NASDAQ, NVIDIA, and the SPY, and they started to fall, NVIDIA will probably fall fastest, right? So this idea of simplifying the process down and being able to take gains and walk away, right? So here's the thing, right? We've talked about this S&P up to 2,400. So for 2 months, nobody's gone anywhere for stocks, but there's been trading every day, right? So has everybody just been sitting around not making any money, or have they been taking opportunities to do something in the market, right? So probably the most important thing that we learned this year and that we've stopped doing and stopped recommend doing and you should stop doing right now is shorting stocks, okay? We said it. We said, you know what? This is a loser's game, and here's why. Because they're out there to teach lessons to the people who think they can bet against the market, okay? So hedge funds, speculators, whoever they happen to be, we call them the Ds, right? Clearing out the Ds. So this idea that you can go in there and start shorting stocks and be on time to cover, it doesn't make any sense, right? You might as well go join the board of somewhere and go to a couple meetings and try and change everybody's culture, right? It doesn't make sense, right? When the tide is rolling one way, it's going to roll you over, right? So being short, any name, I don't care what the name is, most shorted, being short, longest name, highest valuation, Tesla, whatever you want, you're going to get steamrolled when the tide rolls through. So we made a conscious decision not to short stocks, right? That means we're never, ever, ever in a position like, oh, wow, you're dead wrong. We can be long, maybe stocks go down, that's one thing. But we're not going to be, we're not going to be in a situation where we're shorting stocks and we go to a blow off top and we're covering into the storm, right? That's not going to happen, right? Because we don't do that, right? We'd rather be in cash and we can sit on the sideline. So that's the next thing I want to talk about. Is probably the most important thing that we've done is understand this idea that you don't have to play every day, okay? Early in the year, we started out and we said, listen, bonds might not be the place for us to be invested the whole year, right? We have a 40% allocation in our strategy. So what if some of those days that we're supposed to be invested in bonds, we just sat in cash? That 40% in cash, we sat on the sidelines, we didn't bet. Still bet stocks like we were planning on betting them, but for bonds, we don't bet. And some days it was the opposite, right? We say, oh, we're just going to invest in bonds, we're going to stay in our bonds, but we're not going to bet stocks. We think that, and we have a strategy, and we'll go into that later, but the reality is what? If we went in the backyard and I threw you 250 balls and you told me that you were only going to hit less than 12 of them, I probably wouldn't let you manage my money. So this idea that there's more money to be made than people think by shortening the window of their strategy, using a specific set of securities, right? And not getting too greedy, right? And we think about the pace the market should be running, right? What is the racetrack? Market's running around at a certain pace. To get up to 500 points, let's say 10 points a week in the S&P, the way we look at it is like an at-bat, right? We're a baseball player. We think of it as at-bat. The minute we can get our 10 S&P points in any combination of vol and stocks or whatever, we go back to the dugout, right? That's it. and we can wait now for a pitch, right? So, last week we sat out 4 days out of 5. Right? We bet Monday, we sat home the rest of the week. Okay, so this idea of units of risk per return, right? I think we're really starting to make strides there, because again, if I told you there was a horse race later today, but nobody was going to win till next week, would you want to bet? Neither would I, right? So I think we've had a lot of success here with just a standalone strategy. If you never take anything away from this ever again, it's the rain or shine strategy works. It's a great allocation for your 401k. And we're working on it every day to improve it. But this idea that it's a very simple strategy, right? SPY and TLT are 2 major securities that governments of the world buy, right? So if you think about how $1 trillion worth of stocks get bought, has to be done with some sort of coordination, right? You can't just people buying, people selling, right? So it's about a coordinated attempt to load up on stocks. And if you think about it this way, people are going to be dissuaded from owning bonds. There's more money in the world pouring into U.S. stocks, and the valuations are going to start to not matter as much. I know that's crazy talk. I'm saying crazy things. I get it, but here's the thing: everybody's already passed their 2017 estimate for the year, right? And again, we get this rate hike in June, you're going to see more money pouring into the market, not less. So we talked about what could happen if the valuations got up to the upper end, 22.9. We said you can get up to 27. You can get up to over 2,700 on the S&P. So as far as the narratives that we're following, I think we've been checking them off the list, right? Cyber event, the war, these things about, using up inventory. And where we were wrong was we thought we were going to get that infrastructure spend. We thought we were going to get that tax cut, right? Maybe we still might, but those are things that we're still sitting on and we don't have, right? So from the perspective of the market, I think we're doing great, right? I think, if this was a car race, I think we're just about to be getting around that back stretch, and we're about to start going very fast until that June meeting, right? I think we're going to go, through the highs on the S&P and the Nasdaq, right? You saw the earnings come out; they're beating, they're beating the numbers and they're raising revenues. GDP is not the economy, right? If this was about GDP, well, we'd be in deep trouble, but it's not, right? It's about money finding a place to be invested, and I think you're going to continue to see money pour into the U.S. Now let's talk about this. We're talking about a balance sheet mode now. $4.5 trillion in bonds, and whatever they start to do, whenever they start to reduce that, it's like a rate hike, right? So we started to use a number, it's about $500 billion in bonds per 25 basis point rate hike, right? So the way we think about it is like this. We think there's going to be one more rate hike in June, and in September, a comment about how they're going to reduce the balance sheet, maybe down $500 million for first starters, right? That would be the second rate cut that they're talking about, one real one and one hypothetical one, and that's the 2 that they're looking for right now. If that happens, right, if they start to talk about reducing the balance sheet, people are going to just think, well, I can't be in bonds, right? And where are they going to go? They're going to put their money in U.S. stocks, right? So I know volatility stretched. I get it. It can continue, right? It can continue. It's continuing, right? Everyone's waiting for the 10% pullback so they can jump in, when really you should just be swinging right now, right? But again, looking at individual components and hoping the valuation is going to continue is a hard game to play, right? Swinging the greenback, that's easier. So that's what we want to talk about now, is this idea of how you invest, right? Some folks are trading, futures, other folks are doing whatever it is they're doing. But this idea of the 401k really intrigued me recently, because I said, well, geez, you're taking care of the one problem, which is buying at the wrong time, right? Because what are you doing? You're buying every 2 weeks. So if I bought 50% SPY and 50% SPXY every 2 weeks all year, I get the average of those two, right? I mean, sounds like I get the average of 187% gain. When we see that the SVXY was trading at $25, $30 last year, right, for some of the good part of the year, right? So I think the thinking should change to this idea of, hey, I should buy a whole bunch of Amazon, to, hey, maybe I should look to simplify my strategy, put some money in this fast bet, right, in this fast strategy, and rebalance it often, right? As soon as you rebalance something like that, right, because volatility is the one that's going to move, stocks are going to move, right? And think about this. SPXY moved 42%, and stocks moved 32%. So it's a 10-to-1 move that volatility made to get 10% in stock. It's a huge number, right? Yeah, 50-50, it's 60% return. So I'm not here to tell you to short volatility at the highs. I'm here to talk to you about a strategy that we've been using successfully. Take a look at it, and because a 401k has a very long time window and intermittent investments, I think it might make sense as something that you take a look at for the aggressive portion of your portfolio. Not an active manager, not a hedge fund, a basic 1-2 strategy, right? Rebalance, you run it from your cell phone. So now let's move to this new thing that we've been talking about, and instead of, and we talk about it as a car race, but we started talking about the market as if it's an at-bat, right? And the pitcher doesn't like to give up hits, right? So what are they always doing? They're out there trying to be deceptive, right? So everyone's in there in the market, and I watch TV all the time. I watch CNBC. Folks are arguing about valuations or things of that nature, and the reality is, look, nobody has a very good idea of what to buy or sell and at what time to make a profit, right? And it's because the market is always moving in a way that's haphazard, right? And you don't have an understanding of what's happening, right? It's very hard to do anything in options, hard to do anything with foreign exchange, right? And again, we don't even set targets out further than 2 days because of how haphazard it is, right? We can't get anywhere close to the target. So this idea that people are betting with real money on things they have no idea about is the part that, we're seeing it. What hedge fund's making any money right now, right? We just talk about a strategy that's up 30% sitting at your house, not even being there. So again, less is more in this situation. And so that's what we talk about is what's the best place to invest where we are not going to get, thrown at our head, right? Or we're going to crash. And so I'm going to pull this next chart up, and this is the chart of 1% days, plus days, and 1% down days, right? So on 1% plus days, those are the big days we know, right? FOMC day or something big happens, you get a 1% move in the stock market that day. Only 2 of those days this year. And even worse, only 1% big down day. Okay, so you want to talk about volatility being suppressed? This is it, right? Usually every year, 20 to 30 events on both sides, right? So we were thinking about baseball. We could avoid 10 or 15 of those 20 pitches that are at our head and be involved in 10 of the 20 pitches that are going to be those 1% plus days with our green bat. We're going to outperform the market, right? And here's the other part. Once we get those days picked out, we can start to really say, you know what? We're not going to invest on these marginal days. We're going to wait, right? And so that's what we've done is we've taken the chance to look at it like it's an at-bat, right? We have one good pitch to hit this week, and we're going to hit it, or we're going to sit home in the dugout. So I really think, it's a groundbreaking strategy because how simple it is. And every day we call the ball on, where we are, but we try to give you, enough warning so that it's not a haphazard, situation where it's like sell now, buy now. But again, we're trying to outperform the S&P 500, being in the market less. So when we see our opportunity, we take it. And again, those opportunities end up being mostly related to volatility, right? So what we started this year is a volatility regime switching model, and we based it on our proprietary system called the ice cold system. And new idea that we've started talking about this year, which is string theory, right? So I was hearing the other day something about Korea, and they were saying something about a missile defense system. That really rung a bell with me because I think about the market like a missile defense system, right? Maybe think about everybody who's home, they got some money in the market, they're on offense. And, this missile defense system's on defense, right? They're playing defense against all the folks trying to make money in the market, right? So how do they do that? And it's something that we've been talking about for a while, but we really got to go handle on it now. It's string theory, right? There's this way that the market starts to react, and once we start to recognize these patterns, we have an understanding, hey, this is going to be one of those times where the market tap dances and wastes time for a little while, right? We've seen it since March 1st, but we've been documenting it every day, and it's given us the opportunity to say, you know what, we're not betting today. No, looks like it's not for us today. So being able to, and it's just like hitting, spit on a pitch, right? Let it go by, has really sharpened our eye, right? Well, when it's a green day, we're looking for that day, and we're trying to invest in that day so that we can go back to the dugout with our hit and our batting average points. So just very excited because it's working, right? And we've learned a lot for the first few months of the year. Now, here's the thing. Vol doesn't fall to the floor just like trees don't grow through the sky. But we have to remember how much money is out there that's coming into the U.S. market, right? So over longer periods of time, the pressure is going to be where? Money going into the market. Now, are they going to be clearing out Ds in every asset class? Absolutely. Are they going to be clearing out Ds in every individual stock and commodities? 100%. We saw gold fall out of the sky the other day. So, somebody selling $3 billion at once. It's like, who does that, right? Somebody who wants to collapse the price, So looking at the market now, we're priced for perfection, but I have to say this one thing. We're doing significantly better because of how much money is approaching in. Now, that's the final thing we'll talk about is the dollar here. The U.S. dollar has stayed well under control, right? Well under control, and a lot of folks, including myself, thought we were going well over 100. But Treasury Secretary Steven Mnuchin seems to have a handle on things. So does Gary Cohn. Thank goodness for those folks over there, because again, there's been a lot of promises and not a lot of delivery yet. So I trust those gentlemen to deliver on the goods that they talked about. Something that we talked about a long time ago, I never made it to one of our shows, which was they could always split up Merrill Lynch and Bank of America like we talked about a long time ago, right? All those big banks could be split away from, and think about this, Bank of America owns U.S. trusts, Merrill Lynch, they've got properties, right? If this was Monopoly, they got properties over there. So if there's a breakup over there, that's the kind of name that is going to be, they're going to be on that final block, the blues and the greens, right? So from the perspective of the show, we're going to start doing one now every few weeks. We're back on a schedule here. A lot of folks wanted to talk to me. They said, well, how can we learn more about string theory? Well, next time we get on the show, we're going to actually go through an entire, tutorial, doing a whole upstrand, downstrand. We're going to talk about a lot of the things that we do with our charting. For now, I'd like you to, if you get a chance, check out the Rainmaker Top Trades of 2017 paper on rainmakerinvestor.com. Very interesting paper. It's about the taper tantrum. Bank of Canada, we highlighted it this year and last year, and it talks about what happens in the market when they start to withdraw liquidity, they start to do what they're talking about doing, the taper tantrum. So very dangerous for emerging markets like we talked about, and it's a triple whammy, right? It's FX, commodities, stocks, and bonds all get crazy at the same time. So that's obviously what the Fed's trying to avoid. But if you told me we'd have 7.7% GDP and we'd be pressing 2,400 on the S&P today, I would have told you were crazy, right? So everything's going really well. Don't fight it. Everyone wants to fight it. They're looking for it to be a crash. Don't fight it, right? Go for the ride. So for the first time here on the new channel, I'd like to thank you for joining me. My name is Alejandro Reyes. Until next time, keep it real.